Hi, everyone. Mark Sorenson, Chief Investment Officer at Royal Fund Management. In light of the weak market last week and an ugly start today, we thought we'd put out a short market commentary video just to put things into perspective. Obviously, the market's had a very good year, but we've run into some headwinds recently, uh, caused primarily by some economic reports that came in a little weaker than expected. Last week, we had what's called the ISM Manufacturing Index that showed economic contraction. Thursday, we had initial jobless claims that were much higher than expected. And then Friday, we had the unemployment report where unemployment went up to 4.3%. And we only added about 114,000 new jobs, which was much lighter than expected. These economic reports, it's interesting. 2 months ago, that would have been good news because it would have made the market think, okay, the Fed's going to start cutting interest rates. But now it was bad news in light of concern that maybe the economy is slowing faster than expected. When you get short term market volatility like this, it becomes very emotional. And sometimes we make decisions with our hearts instead of our head. In my 42 years, I've been through a lot of these types of markets. And sometimes the best decision is to do nothing. If you like to play golf, play more golf. If you like to read books, read more books. Just simply ignore the market short term if you have to. However, we are seeing signs that this is what's called capitulation. Reminds me of the old saying that people are throwing the baby out with the bathwater, so to speak. You do not want to sell into this type of fear. The volatility index reached a level of over 65 today, up well over 100% just in one day. We're seeing a flight to quality, meaning people are buying treasury bonds and getting out of the market. Historically, these types of emotional decisions cause more harm than the short term correction itself does because of the potential opportunity costs. Here's a little fact that might help you to be able to look past the current volatility. And that's our encouragement. Just try to make yourself look 4 to 6 months down the road, and all will be okay. We still think the economy is going to hold in there. We think that our earnings are growing, corporate margins are improving, and the market's likely to settle in here, set a new foundation to better sustain the next move into year end. But it's interesting, the last time that we're at the end of a tightening cycle when the Fed was raising interest rates was 2018. The market in the fourth quarter 2018 went down nearly 20% as measured by the S&P 500. People made emotional decisions back then. It was ugly. But that we view today also was the market telling the Fed, you're behind the curve. It's time to start lowering interest rates. And ultimately, the Fed back then did that. After that ugly fourth quarter 2018, at the end of the last Fed tightening cycle, the market went up. S&P 500 in 2019 went up 31%. 2020 went up 18%. 2021 went up almost 29%. So we think with the new industrial revolution that happens about every 40 years with artificial intelligence, we think that's going to greatly improve the market opportunity the next 3 to 5 years. So do all you can to just ignore the market right now. We think this is a normal correction that'll be relatively short-lived. A recovery will start soon. We never know exactly where the bottom is, but you have to look 4 to 6 months past it. And historically, the 29 times since 1928 that the market's been up over 10% in the first half of the year, the market averaged 24% for the full year. So we think the bull market is still intact. This is normal corrective activity that has to happen every now and then. In fact, this is the third, a little uglier this time, but the third market correction we've had in the last 12 months. And yet the market always recovers and will again this time. If you have any questions, ask your advisor. They'll be happy to get questions to me if need be. And everyone have a great rest of your day. Bye now.